Have your attention, please. This will be the best presentation you'll ever see in your entire life. The reason why this will be the best presentation you'll ever see in your entire life is I'm going to teach you how to make money. I have published this 300-page book, Trading Volatility. This book has been called the 50 Shades of Grey of Equity Derivatives. And this presentation is a compilation of some of the steamiest sections of this book. You all have a free copy of this book. If you like it, I'd be very grateful if you could give me a review on Amazon. If you don't like it, it makes a great Christmas present. My wife loved it. Now, to make this presentation even more interesting than it already is, I'll be doing it in the form of a quiz. This is why you have this laminate, red and green, on your seats. It's a multiple choice quiz, and typically there'll be 2 answers. Green for yes, red for no. Sometimes there'll be 3 answers. The third option is white. If you want to vote white, wave the book, wave the person next to you, wave anything other than red or green, I shall count it as white. Now, to make sure that people participate, I got permission last week to offer a cash prize if anyone gets every question right. Now, if you think the cash prize is $1, you'd be wrong. If you think the cash prize is $1,000, you'd be wrong. If you think if you get every single question right, you'll go home today with a cash prize of $1 million, you're absolutely right. There are a few rules. You need to get all the questions right to get the million. However, as it's unlikely that anyone will get all the questions right, there is actually a mystery prize for the top scorer. Secondly, you have to do the quiz on your own. You cannot merge scores. Thirdly, unfortunately for me, no Santander employees or relations can win, otherwise I've answered the questions myself and go home a millionaire. And unfortunately for my co-hosts, no other person who might have access to the answers can win. And lastly, you must answer the question before I give the answer. So, they've got the rules. Are you ready to be? Who wants to be a millionaire? Yeah. Come on, you can do better than that. Who wants to play? Who wants to be a millionaire? Yeah. Come on, that's more like it. What is a fair price of implied volatility? Is it white, below the expected future realized vol? Is it red, equal to the expected future realized vol? Or is it green, above the expected future realized vol? So, the laminates, show it up here. Okay, got a few reds, got white there, a few of the greens there. It is actually green, it should be above the future realized vol. Now why? Well, you've got a negative correlation between volatility and equity. So if you have a volatility selling strategy, this means effectively you are long equity risk. So to keep things simple, just say there's perfect minus 100% correlation between volatility and equity. Okay, so if you're selling vol, you're effectively just long the equity market, and if you earn above the risk-free rate from investing in equity, i.e., if there is a positive equity risk premium, then you should earn that positive equity risk premium by selling vol. Hence the fair value of implied is above realized. Now this goes against what a lot of people say. A lot of people say that implied vol is the best estimate of future vol, and that is incorrect. Now, quants get very annoyed with me. We're not in a risk-neutral world. The fair future price of equity is continuing forward, and if you have a positive equity risk premium, that's not the case. We're in a real world, not a risk-neutral world in this case. Next question. Say you've got an ordinary index. 20 vol doesn't really matter, and it goes up 10% in 1 year. What is the most profitable strike for a 1-year call option? Is it 1, at the money, white? Is it 2, in the money, red? Is it 3, out of the money, green? Greens, mostly greens, mostly greens, mostly greens, mostly greens, and it is red. Yep. Most people will say out of the money, or they'll say at the money, but it is actually in the money. Why? Well, if you think that the market's going to go up 10% in a year, well, why are you trading an option at all? You should be trading a future. And what is the option most like a future? In the money. Another way of thinking of it is that 10% in a year, when you've got a 20 vol index, this is not exceptional. This is quite normal. And really, long vol strategies are only really profitable when you get exceptional moves. If you have like a 50% move, then obviously you wouldn't be out of your money. Another way of thinking of it is risk and reward. And in the money option is more expensive. If your view is wrong, you lose more. You are suffering more risk, therefore, if you're right, you should get a higher reward. And we have an example here, we have a nice little chart, and we've got just the key strikes here. So if you have a 20 vol, then an at-the-money option is about 9. So if markets go up 10%, you make a profit of 1, or 11% on your 9 premium. If you have an out-of-the-money option, it's cheaper, it's 6. The break-even is actually higher than the market is. You actually lose money on that. And equally, if you have it in the money, you make more and more money, peaking there, as you can see. Next one. So, say we're dealing with a single stock, around 30 vol. Again, it doesn't really matter. This time it's falling 10% a year. Now, we're going to take all possible strikes, so you take the best payoff for any structure. What is the most profitable structure? Is it 1, long put? Was it 2, long call spread? So red for put, green for long call spread. Mostly red, there's a few greens there. It's around about this time in the presentation people start to do the opposite of what they think. It is actually, and you're thinking, okay, the market's going down, how can call spread make money? It's an in-the-money call spread. It actually makes more money than a put. Again, why? You've got a 10% move, a 30 volt stock. This is not exceptional. This is quite typical. So, you don't want to be long vol at all. You want to be short vol. And if you're long and in the money call spread, effectively you are just long. If you assume there's 5 points hard, you're just long 5 points and short put spread. So ignore the most out of money strike. You're effectively selling vol from the structure, hence you should make money when it's not an abnormal move. So you can see here, strikes 5% apart. The high strikes, you do actually suffer the risk of losing all of your money, but as you lower them, you make money. And so, why would you do this? Well, if you take an index, FTSE or S&P, something with a very long time series, an awful lot of data, well, you'll typically find that in any 1 year period, not just 1st of Jan to 1st of Jan, but taking any 365-day period, what is the biggest decline you get in 1 year? It'll be round about 50%. You do get bigger declines on a multiple year basis, but on a simple 365-day view, it's around about that level. So you could structure a 45-50 in the money call spread, and you'd have a structure that, yes, could, an extreme tail risk event, use all of your money, but if you didn't have that event, you would actually get a yield. It wouldn't be anything like 30, 40, 50% here. It'd still be a decent pickup of the risk-free rate. And you could structure this as a certificate, an ETN, and effectively, what product do you have? You'd have a product that gave you a decent pickup of the risk-free rate almost all the time, and only when you had an extreme tail risk event, an event so extreme that it didn't occur, the Great Depression, World War II, the current crisis. Well, this kind of product would be interesting to fixed income investors. Because effectively they are selling that very low strike, and typically implies are overpriced, and particularly the downside strike, particularly overpriced. So you're effectively taking profit of this imbalance in the objective universe to package something that looks like a fixed income instrument. Call overwriting. So, call overwriting normally enhances returns because you've got overpriced and high volatility. And the number of call overwriting indices, you have to be careful that they're almost all total return indices. So, when you're comparing the performance of call overwriting, you need to compare it versus the total return of the index, not the price return. So, when you're looking at call overwriting, what is the best measure of risk? Is it volatility standard deviation? Red for no, or green for yes. So So is volatility, standard deviation, the best measure of risk for overwriting? Reds, a few greens at the back there. Well, volatility is only the best measure of risk if you have a log-normal distribution. So when you have call overwriting, you actually have a skewed distribution. And there's no one perfect measure of risk. Quite a good one is the Sortino ratio, which measures a downside risk. If you talk about call overwriting enhancing yield, you've got the additional return here, and that's fair enough. If you say reduction in standard deviation, I'm saying call overwriting reduces risk. I'm not too convinced on that one. It's only really downside risk that you're interested in. With call overwriting, you're only reducing upside risk. So has anyone got all the questions right so far? Has anyone got only one question wrong? Is everyone here very shy? Anyone here get only two questions wrong? One there, one there, one there. Okay, so I'll keep you three in the running then. Do you get the best outperformance from call overwriting, an index, or a single stock? Red for index, green for single stock. Okay, so the three that are all right. It is actually red. Because index implied is more overpriced than single stock implied. Typically, from flows, people, when they buy protection, they'll typically buy protection on an index. Why would you buy it on a stock? You must like the stock to own the stock. You know, if you've got a hedge risk, you should really be hedging. But the risk of that stock going down, why would you buy it? But really, the risk of a macro factor, Brexit, or who knows, in a few months, could be Brexit. And also, index implied is lower than single stocks. It's visually cheaper given that protection. So that's the kind of flow that you see. Equally, on the structured product side, often they will have calls on an index, capital guarantee, etc. And so that flow will really lift the value of index implied. In terms of buying protection, Delta 1 you can short, Delta 1 products in order to hedge. Effectively, shorting a Delta 1 product is kind of like just selling a bit of a position, really, if you've got the index. So that's one way, basically moving your position. That's an okay hedge, but it doesn't really give you the upside. So you can use options to kind of protect against the downside, or you can just buy a call option rather than be fully invested. And if you're feeling exotic, you can even go for a knockout option, although post-Lehman knockouts are less popular really, given the fact so many were knocked out in the crisis. Here we have a list of the Delta 1 products. It's very, very difficult to say which Delta 1 product is better than another. I mean, right now there's a big debate, are futures or ETFs better? And it's completely impossible to compare a funded instrument like an ETF with an unfunded instrument like a future without knowing things like the cost of funding. So if any one Delta 1 product was always better than another, then the one that was always worse would simply no longer exist. And from a bank point of view, the Delta 1 market is so big and so competitive, we can't really discriminate between different products. So really, truly, as far as the desk is concerned, they price all products identically. If, however, you want a wrapper that incurs extra fees, for example, if you have a listed instrument, then those fees are passed on to you. You choose that choice, you pay the additional costs. But all of them, with the exception of futures, I'll come to later, all of them will typically use the liquidity of the underlying stock and transfer that to a different Delta 1 product. With futures, if you're dealing with a futures on a big index, S&P, FTSE, etc., with a separate pool of liquidity, then the bid-offer spread for futures can be narrower than that of other Delta 1 products. And so it's very, very difficult really to compare all of them. Here for futures, I'm assuming we've got a future on a sector index that isn't particularly liquid. This smiley face here would be a bit happier if you were dealing with a future on something like the S&P or the Euro stocks. So, on the option side, if you want optional protection, you've got puts, offer complete protection, they're typically expensive, put spreads, protection cheaper, and collars and put spread. And so at the end of all this, we come to the next question. I've always been asked this: what is the best protection strategy? Is it 1, doom puts, deep out the money? If so, white. Is it 2, put spreads? Red. Is it 3, selling your equity position or hedging with a Delta 1 product? Green. So white, red or green? And it's a trick question because it's all of them. Because it really depends what you're trying to protect against. It's not, okay, the best protection is going to be a very long-dated out-of-the-money put, which is incredibly expensive. So, really truly, you need to be a bit more focused. What is the risk that you're trying to protect against? And so, looking at this, I looked at the DAX since 1959, and looked at all peak-to-trough declines, and they're really grouped in one of 3 types of categories. And you've got this crash, this September the 11th style event. You get a very, very short-dated crash, or a very, very high rate of decline. And if you want to protect against that, then it should be a doom put, a near-dated deep out-of-the-money put. If you think it's going to be a bear market, multiple years of declines, just get your position, hedge it at Delta 1 or sell. The most common decline is a correction, you've got a 10 to 22% decline, and it takes, on average, 3 months. And having done analysis over many years of people buying protection, you find the average maturity protection is 6 months, skewed by very few long-dated hedges. The median maturity is 4 months. Still got the 3 that are running there. This is a good one. It's close-to-close volatility and unbiased measure of volatility. Red for no, green for yes. Green, red, green. Okay, close-to-close is actually biased. Why? Well, so you have an ordinary market, no short selling restrictions, random war, as you'd expect, then they should all be identical. Now, does anyone here think that markets always form a random war? Anyone here trades the Swiss euro? I'd like to disagree with that. You have fat tails. Everyone knows you have fat tails, so you can debate about the size of the fat tails, but you don't always get markets behaving in that random war kind of way. Why? Well, panic trading, hitting stop losses, for example. Political pin risk, typically when there's a big decline in the markets, there's often poor support from politicians or from central bankers. Potentially low volumes and VWAP trades. Or potentially there being a correction and misunderstanding of statements. For example, with the Fed tapering, the Fed said the same thing 3 times. Once the market went up, the market went down, once the market went sideways. So when you have these kind of stressed markets, you tend to find that they momentum trade intraday and then correct over a multiple day period. So how can you profit from this? Well, first of all, you need to measure volatility correctly. We have all the different types of volatility measures. We'll explain in the book, and almost all of them available on Bloomberg. And here we have the assumptions: can it handle drift, overnight jumps? The reason why close-to-close is not an unbiased measure is it doesn't handle jumps. We have the efficiency there, and you can see the best is Yang Zhang, and I'll use this to show how biased close-to-close volatility is. This chart here, we have close-to-close minus Yang Zhang. Almost always positive. Typically a point or 2 above. And sometimes 10 points difference, particularly in a crisis. The bottom chart, we have long daily bar, short weekly bar, so this will profit from any kind of whipsawing effects. And you can see the periods of time when you get the biggest difference between close-to-close and Yang Zhang are when you get the biggest payout with a long daily bar, short weekly bar. It's nice, easy for us to replicate, long size, long contracts cancel, and you just delta hedge on the close. And even when you get that very rare negative, you also get the same thing with the long daily bar, short weekly bar. So really these trades are kind of profiting from imbalances in the market when times are stressed, when you get emotions running high. So when you have this example, when you have motions running high, implied vol is typically lies in between the 2 measures, so in between close-to-close or Yang Zhang. So if you like to be long vol, you can just delta hedge on the close and get profit, or if you want to be a short vol, just delta hedge intraday. Or you can do the long daily bar, short weekly bar. So I think that makes you the winner then of our consolation prize. Well, who thinks you should get $1 million anyway?
No, definitely not.
Yeah! We've got a bunch of people who want you to buy the first round of pub. So here you go, 1 million Zimbabwe dollars. Congratulations. Square root of time rule. Typically, you'll find all surfaces move with a square root of time rule. So as 3 months is a quarter of a year, effectively this means that 3 months implied should move by twice the amount of 1 year implied. Or does it? So how do markets move in practice? So if 1 year implied rises by 1 point, do you find that 3 month implied goes up more than square root of time, i.e. a power of more than 0.5? Do you find exactly 2 points, i.e. exactly the square root of time rule, or less than 2 points, i.e. power less than 0.5? So part square root, part parallel. So white for more, red for square root of time, green for less than square root of time. Most green, a few whites. It is actually green. You typically find it's about 0.4, 0.44. So mostly square root of time, part parallel. So there's also a section in the book that talks about modelling volatility surfaces and the reasons why you have a square root of time rule. So the reason for a square root of time rule is the fact that if you buy a put spread, you need to pay. You shouldn't earn a premium by buying a put spread. And if you have skew decaying not by square root of time, then you can find that short put of a put spread can be worth more than a long, therefore you can earn money buying a put spread. But it's roughly square root of time for near-death securities, which means that you can actually compare skew and term structure across the vol surface. So here we have not a particularly nice formula, but you can actually compare two different term structures here. So I have a 6 month, 3 month, and 1 year, 6 month. And you can see pretty correlated. Equally on the skew side, a slightly easier formula, just square root of time. You can see there that skew is very, very correlated. We normalise it that way. Here's a good one. How does the realised volatility of a stock compare to the realised volatility of pre-earnings? Is it white? Greater. Is it red? Equal? Is it green? Less. Green, a few reds, it is actually green. You tend to find that after earnings, stocks are 25% less volatile. So a lot of people do earnings implied jump. There's functionality on Bloomberg for that. But you have to be careful. If you're going to assume the volatility after earnings is going to be exactly the same as before, it's not the case. Leading up to earnings, people will put out previews, there'll be a lot of chatter, a lot of noise, and there's an uncertainty about the earnings. And then once that uncertainty goes, vol drops. Slightly more morbid, you find the same thing going into a war situation. Things will be volatile going into war. When war actually starts, or definitely doesn't start, uncertainty is gone, and implies will go down. Equally, you need to normalise the market. So if you have upwards sloping term structure everywhere, if you use that for the implied jump, which can be quite sensitive to the differences involved, you tend to not get too great an output. Which is why when we do it, we tend to assume the index term structure is the overall market term structure. I've tried other ways by averaging single stocks, but it tends to get zero results. So we adjust by the index term structure to back out a better implied jump. Right, here we have a delta hedge option. And the payoff is not volatility, it's variance. I.e., if you have a 1% move, you make 1 profit. If you have a 2% move, you make 4 times the profit. This is why people trade variance swaps typically. Volatility swaps are post-crisis becoming more popular. But variance is what you get. So, if you're looking at the profit or carry, what should you look at? Should you look at red, the difference in volatility, i.e. the carry from buying a 20 vol option when realised as 1 point higher is exactly the same as buying a 40 vol option when realised as 1 point higher? Or should you look at the difference between the realised variance and implied variance? So green, i.e. the carry from buying a 20 vol option when realised as 1 point higher is half the carry from buying a 40 vol option when realised as 1 point higher. So do you think you should look at the difference between realised and implied vol, red, or realised and implied variance, green? a couple of reds, and it is actually red. This is why the title is why everything you think you know about volatility is wrong. Why? Well, gamma. Formula for gamma, in the denominator you have volatility. So if you double vol, you halve the gamma. So you've got the red line there, and the grey line you can see not nearly as steep, and therefore that cancels one of them, and therefore when you're looking at carry, you should look at the difference between realised and implied volatility, not realised and implied variance. Getting complicated now, pair trades. If you're putting on a pair trade, and this is where I'm assuming the pair trade is within two securities at the same time. So you're doing index versus index, or single stock versus single stock. Should you theta weight them, either net theta position 0, vega weight them, net vega is 0, or dollar gamma weight them? So red for theta, green for vega. Okay, and would anyone change their mind if a pair trade was a dispersion trade, i.e. short index, long single stock? Would this train go answer? Well, let's see. If you are theta weighting them, or correlation weighting them, this is effectively assuming that volatility moves in a proportional way. I.e., if you have a low vol stock at 20, increasing to 30, you assume this is a 50% increase in vol, and therefore a higher vol stock of 25 should go to 37.5. And if you're looking at securities of the same type, i.e. index versus index, or single stock versus single stock, and that tends to be the way they trade. And so therefore you should theta weight them if you're dealing with securities of the same type. If you're doing a dispersion trade, because you have a bit of a mouthful, the correlation between volatility and correlation, the fact that as you go down, vol goes up and correlation goes up, this means you should really favour them. The single stock leg is 2 to 5% too large, but we're going to forget about that. Because if you might be forced to exit dispersion trades, typically when times is up, so rather than mess about the time, you just choose pretty much vaguely. On the dispersion side, the reason for this if you're going to trade these balance, all these people buying the protection we talked about earlier, that's lifting index implied versus single stock. So, do you want to trade, so if you've got implied correlation realised, do you want to trade with the correlation, or are you trying to trade with richness and cheapness? So it's really that the imbalance you should try to trade, and you should favour weight or dispersion trades. If you're doing a pair trade between two types, you should theta weight them because vol moves in a proportional way, whereas vega assumes you're moving more in an absolute way, i.e. if the low vol stock moves from 20 to 30, it's a 10-point increase, the single stock should go from 25 to 35. So that's how single stock and index vols will typically trade, but at the same time, more in a proportional way. How does the issuance of structured products impact moves and implied volatility? Is it white? Have no effect. Is it red? Dampen implied vol moves? Or does it green? Exaggerate implied vol moves? Green and red. Bit of a mix. It actually, green, exaggerates implied vol moves. Now why? Well, the sale of structured products will cause investment banks to be short skew and short vega convexity. So, here we have a short skew position. Say you have equity market decline. All of a sudden, the downside short, this becomes more important. So, traders become short skew, therefore they buy vol, go around the vicious circle. Vega convexity means that traders become shorter vol as vol rise, round and round you go. This is why when you get vol spikes, often vol seems to overshoot. Equally, when you get a period of time when vol will collapse, like after the tech bubble bursting, or after Lehman, etc., then you do get a quite steep decline in vol. So it can work both ways, mostly with the vol spike, but it can also with the vol being crushed. You can suddenly find a very, very quick movement. And so this goes very nicely with the first question, that is implied vol an unbiased estimate of future vol? Well, you've got something that, one, it's always higher, and two, tends to exaggerate moves. So I'll be careful using implied vol as a fair estimate of the future vol. Right, at the money implied vol. How much should at the money implied vol move if markets rise or fall? Now we're assuming skew is fairly priced. Should it be white? move an amount equal to skew, i.e. sticky strike vol. JIT 2, move between 1 times and 2 times skew, red. Or JIT green, move by 2 times the skew. So white for sticky strike, red for between 1 and 2 times, and green for 2 times. White. Good. A few kind of greens there. It is actually green. Right, in order to explain this, I'm going to talk to you about local volatility. Now, local volatility is actually think of the Black-Scholes as being the average of all paths of local vol, and local vol is really instantaneous vol, how much moves at each point in time. But a good approximation is it's just average. And so if you have, for example, at the money of 20% and the 90% local vol of 22, then the Black-Scholes will be the average of 21. For at the money is local vol and Black-Scholes are absolutely identical. I know I've gone over that quite quickly, there's a longer explanation in the book, but just take my word for it. Best is an average between the current price and your strike. So for at the money, they're identical, because the average of 2 numbers are the same, exactly the same. And because of the averaging process, we find that Black-Scholes skew is half the local vol skew. So here we have different volatility regimes. The black line is a sticky strike and where the vol surface is right now. The red line is sticky delta, so you can see that it kind of at the money stays constant no matter how spot moves. You have green, which is a sticky local vol. Now the reason why skew will move twice that amount is, take the previous example, if you have right now, I'm at the money, I'm 20 vol, both local and Black-Scholes. At the downside of 90, that's a local vol of 22, meaning it's got Black-Scholes of 21. But if I go all the way down to the 90% strike, and local vol hasn't moved, local vol is 22, my Black-Scholes vol has gone up from 21 to 22. So you find then that as markets go down, the vol surface goes up by amount equal to the skew. For sticky strike, it goes down by the amount identical skew. And I've chosen this one here, jumping vol. That's just vol moving far more than you expect in sticky local vol. So we have the P&L. Sticky delta, sticky strike, sticky local vol, and jumpy vol. Well, how does the remark impact you? So here we have sticky delta. Effective markets go down, vol surface goes down. So if you're long skew, you lose money. If you have sticky strike, by definition, you make or lose nothing on the remark. If you've got sticky local vol, you will profit, and if you've got jumpy vol, you will really profit. But if you're long skew, and you've got your normal negative skew, so you're long the 90%, short the 110, you're buying a vol at a higher level of 90% than you're selling it at 110. Therefore, your theta bill is higher than you'd think it would be for flat skew. So I call this skew theta. Definition in the book is basically what I do is I assume that the fair price of gamma is the at the money, and therefore you're paying skew theta by buying the downside strike by a higher vol, and you're also paying skew theta by selling the upside strike, selling at an implied less than at the money. And you put the two together, and you get the variable. And you can see that if skew trades are fairly priced, skew trades break even, it is in the jumpy local vol regime. But typically you find markets will trade in between sticky strike and in between sticky local vol, showing that not only is vol overpriced, but typically skew is overpriced, which is as you'd expect. Because if you're going to buy downside protection, the person providing it wants to make something out of it. I mean, how many people here buy car insurance without the car? You don't buy insurance because you think it's a good trade. You buy it because you want to be protected, and you're prepared to overpay for that risk, which is why skew and vol are typically overpriced. But you do find markets move in all different regimes at different points. A jumpy vol will typically be a crisis. Sticky delta will be more when you've got calm, smoothly moving markets. So you can get all 4 different regimes, but typically it'll be between those two that markets typically trade. So, how is it that this happens? Well, Vanna is the size of skew position. That's d delta d vol. Now, if you have a spot vol correlation, you do the maths and you find that it's basically similar to gamma. I can show you in practice why this is the case. Here we have delta hedging due to trading skew. Markets go down and vol goes up. See the delta? It's increasing, so you've got to buy more of the underlying. And the reverse on that side as well, to sell. But if you happen to buy spot when markets go down and sell it when it goes up, it's the same as delta hedging gamma. Market goes down, you have to buy. Market goes up, you have to sell. So trading skew is really like trading second order gamma. Right, this is the last question. How to make money? Well, a good way to make money is going back in time and putting on trade when you know the future. So, I'm going to let you go back in time and put on any trade you want. On the vol side, well, what would you want to do? Not much of a vol market around the Great Depression, but there certainly was around Lehman. Wouldn't you like to go back in time and buy vol, particularly Dec 08 vol, just after Lehman going vol? So, vol was quite elevated beforehand, but if you go back to April, it wasn't actually too overpriced vol. You could actually have bought in April 2008, and at the money, Dec 08 straddle at an implied of 22. The realised between the time you bought it and expiry was 42, so 20 points higher, almost twice. So say you bought this and you delta hedged on the close, the delta from Bloomberg or any kind of risk management system that ultimately input the implied vol as the fair price. So using standard market practice, delta hedge on the close with that delta from the price of the market, with this trade make money. Red for no, green for yes. Okay. Green for this is where people start to do the opposite here, a bit of a mix here. And you would have actually lost money. Now, these slides are basically a compilation of problems I've encountered in my life at different firms. Because this is something that you really want to make sure you learn from. That if your view of the market is correct, you want to make money. The reverse problem, that you make money even when you're wrong, is less of an issue. You want to make sure that if your view is right, that you profit from this. And there's a number of times when traders come to you, oh, what's going on? I bought some downside vol, and I was hedging, and the market's buked, and why am I losing money? Well, the problem is that Black-Scholes has two unrealistic assumptions. One is that you're psychic and you know the future realised vol, and you use that to calculate your Greeks. I'm using delta here as the example, it'll apply for all Greeks. Secondly, assumes you've got the ability to hedge continuously. There's no such thing as market close, no such thing as a weekend. So if you have this unrealistic scenario, then when you delta hedge an option, there is no volatility, no doubt in terms of how much money you'll make or lose. The x-axis here is the difference between realised and implied, i.e. how rich or cheap an option is, and the y-axis, how much money you make. And it's a perfect straight line, there's no doubt whatsoever how much money you'll make or lose. So what I'm going to do is I'm going to stretch each of these assumptions in turn and put the two together to get a real life example. Okay, if the future vol is unknown, then your delta is incorrect, because you'll be calculating the delta and all the other Greeks from the price in the market typically, and if you're buying a cheap option, this means that you'll make a smaller profit if the market goes down and when the market goes up. So if you're buying vol, and vol is higher, well, typically that'll be when the market goes down. So that's the key thing. The market goes down, you're making less money than you think. Here we have the P&L with a plus or minus 1 standard deviation. If the market's perfectly priced, you're back to Black-Scholes again, so it goes through the point, the origin. So you still always make money buying a cheap option and lose money buying an expensive option, but there is actually path dependency in how much you make or lose. Reversing the assumptions, you are psychic, you do know the future vol, but you have to discreetly delta hedge. And if you've got a nice random walk, a well-functioning market, no short selling restrictions, effectively, discreetly delta hedging is that noise. And if you quadruple your delta hedging frequency, you halve the standard deviation of your P&L. And in this example, it is possible to lose money buying a cheap option and make money buying an expensive option. Here we have the two together real life. The red line should make hedging with the correct delta. The grey line is what you actually made using the delta, taking the value from Bloomberg using prices in the market. And then you have the P&L depending on how rich or cheap the option is. So why has this happened? Well, if you bought an at the money option in April '08, spot was significantly higher than when it was when Lehman went bust. So the strike is above spot. So forget about the call option, irrelevant. You are long in the money put. And if you use the implied vol as your calculation, then you've got a delta pretty much minus 100%. So you're long close to minus 100% delta. And the difference between that delta and the actual delta, given the high vol post-Lehman, was up to 24% difference. So you're long up to 24% too many futures over Lehman bankruptcy. And that is why you get the big difference between the two. So what I think is that fair enough for risk management, you need to have that estimate of future vol and implied, imperfect as it is, you'll probably have to do. But for your day-to-day hedging, you should use a vol target price. If you bought 22 vol thinking it's cheap, what's the fair price? 25, 30? Whatever it is you think it should be, you should bump your surface by that amount and use that to calculate the risk. Risk managers get very, very annoyed with me when I say this, but you should really want to make sure that when your view is correct, that you make money. And if you're going to buy a stock, you'll typically have a target for it. So why not with volatility? Have a target. Some systems will have a vol ladder in addition to a spot ladder, and you can use that to say, okay, what should my greens be? Because true life examples, not just over Lehman bankruptcy, with any kind of downside, there's been traders who have bought vol thinking that they would profit and ended up not profiting and wanting to know why. Now this is different to having a different delta due to what we securities. It is due to what you think the fair value of future vol should be. Right, well, I've gone through a fair number of questions. Hopefully you guys have enjoyed listening to this presentation as much as I've enjoyed giving it. If you have enjoyed this presentation, I have one small favour to ask. Could you please put your hands out in front of me, if you enjoyed the presentation. Go on, you know you want to. And then, thank you very much.